Welcome to day 6 of the Gold Summit. Today, it's my turn to sit down for a chat with Fleet Street letter editor Nick Hubble. Nick and I are going to discuss my book, The Golden Revolution Revisited, which introduces the idea that monetary game theory dynamics at the international level are going to contribute to the remonetization of gold, perhaps as early as 2025, to settle international trade. That will increase the demand for gold at the international level and the demand to hold cash balances to settle transactions. That increase in demand implies a very large increase in the price of gold in the market. To learn more, please watch my discussion with Nick Hubble.
John, thanks for coming in. What do you think of the Gold Summit so far?
Fantastic. I think it's great that we've managed to bring together such a diverse and global group of gold experts who are able to approach it from different angles, because there are different angles. There's not just one story behind gold. Many of them have merit, and indeed it's sometimes difficult to decide which is the most important at any given point in time. Hence, they're all worthy of consideration.
Even in hindsight, we can't figure out who was right sometimes.
Oh, absolutely. There are just too many variables.
And it's been great to see a lot of new things pop up. We wanted this Gold Summit to not be too much of a broken record with examples from people who have been saying the same thing for decades, even though they've been proven right. We brought in some new big ideas, which I've been surprised. Yours, however, is intriguing. It's an intriguing example of the way you think. So let's dig into your catalyst for the gold price in 2025. It is the global shift in the currency versus gold demand function. So there's two halves here. Let's tackle each half separately and then bring them together and explain the connection to gold itself. What is the currency demand function?
Well, the fact is that if you're going to engage in international trade, you need to use some currency for that trade, for the financing, for the settlement of whatever trade is taking place. And that means you're going to have, there's everyone who's active, everyone who's participating is going to have to hold cash balances, or they're going to need to have access to lines of credit in whatever currency is being used in trade. Now, as we know, under the Bretton Woods system, post-World War II, those cash balances have overwhelmingly been dollars. It has been the dominant reserve currency for central banks, but more than that, it's simply needed for day-to-day, run-of-the-mill international commerce. So there's a demand function for these dollars that are used in international trade, above and beyond what central banks may happen to hold. They're both important. But the point is this, is that we've come a long way since then for a variety of reasons. The US share of the global economy has been declining for decades. Of course, the flip side of that is that China and the BRICS in general and other emerging markets have been growing their share of global trade. And they were more than happy to use the dollar still as the legacy of Bretton Woods throughout, until you got into more recent times when the US decided it was going to use the dollar in a way that would basically be an instrument of foreign policy, above and beyond just an instrument of the US financing its deficits, its trade deficits with the rest of the world. And through sanctions, the dollar's now been effectively weaponized. That has not only been a problem for Russia, the direct target of that weaponization in most cases, although you could say Iran's been under a target for years prior. But it's a warning to everyone now. It's a warning to everyone that if they want to continue to engage in international trade without the potential danger of just falling afoul of the US at some point in future on who knows what issue it might be, they're going to have to consider alternatives to the dollar. And so we've seen now, although it's early days yet, the beginning of a shift out of just holding dollar balances and using dollar lines of credit to support international trade to using alternatives. That, I believe, is really going to accelerate in 2025.
So I've been living in Japan for about a year now, and so I can tell you a very long list of traditions that have outlived their useful life. And it feels like the US dollar is in the same position where the world is continuing to use it for reasons that made sense long ago. Before this issue with Russia occurred, it was already starting to make a lot less sense, yes, right? Yes. So the foundation was already gone, but you see this Russia story as a trigger, an awakening. What makes you so confident we go back to gold as opposed to this weird currency system coming up with some new bizarre iteration, some SDR IMF system or some BRIC system that doesn't use a gold, or some new political creation, the Bancor or whatever it might be? Why are you so confident in gold?
Gold, as I claim in my book, solves for the game theoretical international monetary equilibrium for a globalized world highly dependent on trade. Now, that's a big mouthful. What do I mean by that? Gold is not any one country's currency. It is genuinely international. It is neutral. It weighs the same everywhere it goes on the planet. Everyone can use it as a universal point of reference. More importantly, when you look at the international system, and this includes the international monetary system, there are degrees of cooperation and there are degrees of competition. And those two are interacting with one another constantly. You try to cooperate with other countries, but you're still competing with other countries. This is true in military affairs, it's true in political affairs, it's true in economic affairs and monetary affairs. The problem is this: if everyone has their own national currency that they can try and manipulate through devaluation or weaponization or whatever it might be, to try and rig the system in their favor, to give them favorable terms of trade or whatever it happens to be, then there's a relative lack of trust that doesn't facilitate trade at all. And yet we have this hugely globalized world, incredibly dependent on trade. And so the way to solve that problem of competition with national currencies is simply to embrace a universal reference point, gold. You might say, well, hold on, can everyone really cooperate to do that? It's the opposite. It's when everyone can cooperate that you do that. And the example I love to use is from the film A Beautiful Mind, about John Nash, who discovered his eponymous equilibrium, for which he will win the Nobel Prize in mathematics and economics. And basically, the deal is this, is that in the movie, a young John Nash and a number of his PhD colleagues, students, they go out for a night to a bar, and they're chit-chatting with one another when in walks a group of attractive young ladies. And they immediately want to start, chatting with these ladies. I mean, this PhD program is very male heavy, right? And so it's delightful to have the opportunity to chat with some young ladies in the evening, and they have this opportunity now. It just so happens, though, that one lady is particularly stunning. She's particularly tall, she's blonde, well-dressed, and all of it. And as they begin to approach them, they all kind of want to chat her up first. But John Nash realizes there's a problem with that. If we all try to chat up the blonde, we're going to put off her friends. And the blonde herself will be sort of put off and feel awkward. And they won't settle into the bar. They may just choose to leave, and they won't chat with us at all. The way to solve this problem is for the group of young men to agree that no one chats up the blonde. That's the only workable compromise. It represents the Nash equilibrium in that case. That's what the printing press versus the gold is like at the international system. Everyone simply wants to be able to print money. Everyone wants to be able to manipulate their currency. The only solution to that is to agree to use the gold instead of the printing press. So that is the parallel that I sort of draw. It is game theory applied to the structure of the international monetary system that will result in gold demand being the primary beneficiary of a decline in reliance on the dollar for use in international trade. And I believe this is really going to get into gear in 2025.
The same analogy works for the breakdown of the current system, where the US dollar as the global reserve and global trading currency only worked to the extent that the US promised not to do what it just did to Russia.
Yes, indeed. And for every country that has seen that, however small, that has seen that and has considered alternatives to the dollar, their reserve balances, their commercial balances, their lines of credit will have tilted away from the dollar just a little bit. For every currency, every country, however small, that does that, some other country has to take up the slack and increase their reliance on the dollar, increase their reserve balances in dollars, or the system drifts ever closer to an eventual tipping point where you get a big shift in the demand function for dollars versus gold to gold's benefit. And the final part of that is that this is a nonlinear process. It appears incremental at first, but in fact, it's an exponential function. It's a curve. So you don't know where that tipping point is. But when you reach it, that curve will be very, very sharp. And there's simply not a flexible supply of gold to address that sudden big shift in demand for gold, that nonlinear shift. Hence, the price impact of this is disproportionate to what's actually happening with the balances themselves in the market.
Which is how we get to the gold demand function next. So you've talked about the explosive part, which makes sense to me, once the cat's out of the bag. But before that, the incentive is for these countries to accumulate as much gold as they can, which is what they're doing. Yeah, so take us through which is what they're doing. Take us through the extent to which the central banks and governments have been accumulating gold and whether that's driving the gold price so far.
It's certainly a factor behind it because you've seen, the World Gold Council compiles these numbers, and you've seen year after year now for a good, it's been about 10 years, ever since the global financial crisis pretty much, in fact, you've seen an increase in central bank gold buying. And you step back from the chart and you see that not every year shows an increase, but the general trend has been to increase gold purchases. You step back from the chart and it's been taking place for such a long period of time now. It's clearly not price opportunistic. It's really a strategic decision. And while they didn't reach that decision collectively, it looks as if it's a decision that was made by a majority of the world's central banks. So this is a very well entrenched strategic trend, which arguably accelerated when Russia invaded Ukraine and the sanctions regime was really ramped up.
That was the record
by the United
year,
States.
2022.
Yes, that's right.
Take us through then how this steady accumulation of gold becomes that sudden surge, the cat out of the bag moment. What does that scenario look like? What triggers it? When might it happen?
Right now, we're really only seeing the growth of reserves. We're not seeing yet the implementation of gold as an actual international transactional alternative to the dollar. The balances involved in that are an order of magnitude greater than what sits as reserves. Just as a bank, just any old bank, right? What you hold in reserves as a bank is only a fraction of your commercial lending activities, your deposits, and so on and so forth. It's only a fraction. The same is true at the international level. In fact, it's even more true at the international level because of the euro-dollar market and all the various layers of financing that take place behind international trade. So if you start getting demand for gold as an actual transactional alternative, and I don't mean physical gold, I mean lines of credit that somehow reference gold or balances that somehow reference gold, that is going to see a much, much larger shift, way, way, way beyond what you've seen by central banks so far in terms of the overall global international demand function for gold.
Take us through timing and what people should look for, say, in the news or in the markets that might suggest we're on the cusp of that sudden parabolic change.
If you start to see, I would focus on the BRICS because they're the biggest players in this, and arguably they're the ones that are practically driving this transition. If unconsciously, I'm not saying they have a master plan, although some people think they do, it could almost be unconscious that the BRICS will begin to ad hoc and opportunistically engage in some long-term trade agreements for strategic resources that may be linked in some way to the price of gold. That is, they'll periodically settle, almost like it's a swap, they'll periodically settle their bilateral currency exposures with one another, be they in rubles or yuan or whatever it is, but they'll settle it with reference to gold. Why? Because that is a simple way for strategic long-term trade to prevent your trading partner, again, from trying to manipulate their currency if ultimately the reference point goes back to gold. If you start to see those ad hoc arrangements spring up, it's then only a matter of time, maybe a short time, before it actually starts to become institutionalized in a framework that they put together. We're not there yet, but that's what to look out for.
Because that settlement mechanism has to be independent from control of either party, right? It doesn't work if we do a business deal and we agree to settle in something that I or you can have complete control.
That's exactly right.
I don't think we've mentioned yet this divide between the reserve asset and the trading asset in the way that I know you do very well, because these are two points that are conflated by many people who are bullish about gold. So take us through that explanation that I've often heard you give of the difference between the two and the relationship between the two.
Well, it's because the fact is, if gold is only ever used as a reserve, if it's only ever used as a store of value, it's basically idle. But if you get into a situation more akin to the way things were throughout most recorded monetary history, and this includes the classical gold standard period of the late 19th and early 20th century, gold actually moved. Right? Gold was actually the basis of finance and trade, cross-border finance and trade. And you would actually have gold settlements taking place from time to time. And in that sort of world, the transactional commercial demand for gold is an order of magnitude greater than if it's only ever just sitting in a vault somewhere as a potential store of value or reserve against financial calamity of some kind. And so that's what I think we're going to get back to. We're going to get back to a world in which this transactional demand function for gold, which is practically non-existent right now, although you see a little bit going on, that's going to be an order of magnitude greater. And at the same time, central banks will probably just keep on accumulating as they've been doing anyway.
Let's combine the two stories even more clearly now. We've got the demand for the currency shrinking because of geopolitics, and gold is the obvious solution, so its demand function increases. Which of the two do you think will be the dominant story or the first mover or the thing that is sort of acknowledged in the media as the part that's moved?
I think the currency demand function for dollars weakens first. And I believe that the one reason for that is also just that private investors, be they institutional or be they high net worth individuals or just typical households, they'll also start to see that national currencies in general, and this includes the dollar, aren't the stable stores of value they once thought they were. And this is because of national debt problems, right? We're going to see this inflation so embedded now that people are going to take the initiative at all levels to try and protect themselves from that. And so you're going to see this demand for dollars declining, a willingness to hold bonds in dollars declining, and gold will re-rate as a result just of more people getting in on the store of value argument than currently are. So the currency demand function for dollars as for savings is already declining and will continue to decline. Now, these households are not going to start using gold, right, when they go to the supermarkets, right? That's the very last stage of demand for physical gold going up. But when you do get to these big contracts between countries for a strategic trade that will have a gold reference point, that will be a big driver. So I do believe the currency demand function for dollars is already declining and will continue to decline, and that's happening at all levels simultaneously. But when you start to see big players actually going for gold as a transactional reference point and medium, then that will begin the cascade towards elevated gold demand that will really send the price an order of magnitude higher.
I'm debating in my mind whether Trump accelerates this or decelerates it, because there's this weird irony in the fact that the catalyst with Russia and their reserves being confiscated occurred before Trump, but now he's sort of in charge of this sort of catalyst continuing, right, in 2025. So he's got his finger on this new weapon that previously the US government didn't really use because the system only functions to the extent that they don't pull the trigger. What's he going to do? Is he going to make this trend accelerate rapidly and start, confiscating left, right, and center of anyone who's a political enemy? Because now it's on the table.
Look, I don't think you can rule anything out. He's a negotiator. He's a businessman and a negotiator, and he has a long track record, first as a businessman, later as president, being someone who practically enjoys brinksmanship in negotiations. That is, he enjoys the price discovery, as it were, that comes with that sort of brinksmanship. But that can be a very dangerous game to play. Yes. And the fact is, if you are not a member of Trump's inner circle, you really don't know what's going to happen. And so that's true of basically every country in the world. They honestly do not know how to predict what he's going to do. And that just raises the uncertainty. That just raises the risk in not knowing what Trump's policy will be. But we do have some hints what some of his policy set will be. First of all, he's going to threaten tariffs to get better terms of trade with the rest of the world. That's a risky game to play. He might succeed, he might not, but it's a risky game regardless. And he does seem more inclined to try and get his way with tax policy than to come to terms quickly with the legacy debt burdens and entitlement spending policies that really dominate the U.S. budget situation. Debt service is now bigger than the defense budget. Entitlements are an order of magnitude bigger than both. Okay, that's really going to be difficult. I suspect that, as almost any politician would do in that situation, Trump will see at least some inflation as part of the solution to solving the debt problem. And that debt problem is growing exponentially now. And even in his first term as president, I think you might see Trump just kind of accepting the fact that a certain amount of inflation is part of the solution here. Now, I believe that puts the U.S. on the road to gold also, because you can't just inflate forever, right? Someday it has to end. But I actually think it's the rest of the world responding to U.S. policy set, fiscal and monetary, that's in the driver's seat this time around, not the U.S.
Yeah, it's also connected, because if they use inflation to try and deal with the debt problem, that creates this global reserve currency war type scenario.
Yes.
And so that's the connection there. What I'll be fascinated to see is who makes which move first in terms of the geopolitical side, though. This attack on Russia, whether the Russians and their economic allies, or just anyone who's opposed to the US, whether they make the move towards gold or away from the dollar, or whether Trump tries to see how well this, whether they can fire the weapon twice. They fired it on Russia first, whether he uses it as a policy tool, because it will go down in history as America's mistake or the foreigner's attack, right? It's two very different versions of history.
But it's like a lot of wars. Some wars are preemptive, or some are what you call a preventative war. When you deliberately start it, but you deliberately start it because you assume in the future your adversary is going to have some big advantage over you, so you've got to strike today. Other wars are simply purely defensive. It's all of the above, right? And this could play out in all of those ways. But what we do know is this: the structure of the international monetary system is no longer compatible with the structure of the international system in all other dimensions, right? Military, political, economic, all of it. It just doesn't line up anymore. And so when the moves are made, whoever preempts, whoever prevents, whoever acts defensively, whoever acts offensively, so on and so forth, historians will look back at it and they will see how it had to happen. In a way, it had to happen. Precisely how it happened is anyone's guess, but they won't be surprised that it had to happen.
And it shouldn't matter to gold investors.
No, because there's only one way that this is going to go in terms of price. You'll have volatility, of course you will, but when the smoke clears and all is said and done, gold will have re-rated by an order of magnitude. And I've run some numbers here. I've run some numbers where you look at gold as a ratio. You look at it as a ratio vis-a-vis the existing debt stock. You look at it as a ratio of the existing money stock. And it should be no surprise that the debt and money stock are highly correlated, okay? Okay. So you start looking at these ratios and you think, okay, well, if we were to completely reset the system, and if we were to back a certain proportion of international trade with gold linkage, actual, underlying the system, you're talking about gold prices in the tens of thousands, right? An order of magnitude higher than where we are today.
Is this a good news story? Are we going sort of back to sanity and it's the end of the ridiculous period of being on a fiat currency global system? Or is this a big crash, a big nightmare first? I know we're both often accused of being very pessimistic, but I suspect you're going to argue that actually it would be a return to a good thing.
It would be very disruptive. Yes, there's no way to reset the system without disruption. You can look back at history and you can see disruptions that weren't actually all that disruptive, and you can see ones that were pretty catastrophic. Now, I'm actually optimistic in that regard, and one reason why is because the world is so incredibly globalized. We are already trading with one another in a way way more integrated than ever before in history. And what that means in practice is that more people know other people, are doing business with other people cross-border as a percentage of the global population than ever before. So the human race is way more invested in some sort of less disorderly transition from where we are today to where we're going to be. And that gives me hope that we'll see a surprising amount of cooperation when this actually begins to kick off. But there's no getting around the disruption that will have to take place. And so I do believe we're going to go through a period that will make people very uncomfortable. But the more gold you own when we go through it, the more comfortable you will be.
And that applies to both countries and households.
Absolutely.
Would you argue that, so what we're really talking about here is the decline of the US as this all-powerful economic, and the US dollar as this all-powerful economic. The UK experienced that as well. It was the empire before. So take us through, because I would argue that it went quite well for the UK, perhaps because we passed it off to an ally. So that would be the more optimistic version. What's the more concerning one? Because I mean, I can't imagine an American administration handing over power in a way that's not very disruptive to the likes of China.
You need to look at a couple of things here. First of all, take a look at how the classical gold standard came into being in the late 19th century. It didn't come into being as a result of a master plan. It kind of came into being spontaneously. You had the British Empire as the preeminent economic power during most of the Victorian era, but in the late Victorian era, among others, of course, the United States was already industrializing rapidly, but now so were Russia and Germany, France, other countries industrializing rapidly. That meant that economic power was becoming much more dispersed internationally, and Britain no longer had the same sort of dominance. And we're seeing that now, but we're seeing it occurring without gold being the predominant medium for international trade. So there's a similarity there and there's a difference, but it's this multipolarity which I think is key. And so you might say, well, hold on, Britain was able to manage this transition to the US relatively calmly, but it had already transitioned to a much more multipolar distribution of economic power before it eventually, as a result of World War I, basically bankrupting Britain for the most part. Britain had the US to fall back on. So if we don't go through something as devastating as World War I this time around, I see no reason why we cannot get through a transition with the US not needing to hand off to any one country, any one victorious party, say, in a major global conflict. It can be done more seamlessly like the classical gold standard transition took place. But the second thing I'll say is this. What we do have to fall back on, in my opinion, is that over the course of the last 30 years, nearly 2 billion people who were not well integrated into the global economy became integrated into the global economy through the rise and industrialization of the emerging markets. In theory, while I know a lot of people say, oh, unfair trade practices, we're offshoring jobs, the reality is that the fact that these 2 billion people are now available to trade with, are available to specialize in whatever industry, on paper, using your Economics 101 textbook, you can only argue that the potential growth that brings to the global economy is all the more greater. We can fall back on the fact that more people are actively engaged in commerce than ever before inside their own countries and globally. If we simply could get governments out of the way, this is going to sound a bit idealistic now, if we could get back to relatively low tax, relatively market-driven economic dynamism rather than the let's face it, closeted central planning we've been living under for the last generation or so, if we could get back to something also a bit more 19th century in its economic dynamism, we could unlock all that potential. And we could resume the sorts of growth rates that were common during the Industrial Revolution, 5%, 10% a year, with even more people engaged in the global economy than ever before. So I'm optimistic. But yes, we're going to go through the disruption first, and you're going to want to hold gold as we do.
What makes your argument so fascinating, though, is that you want to hold gold during the disruption, but gold also plays a key role in that optimistic scenario that comes after, right? Because we've transitioned to that. That's why I think your thesis is so fascinating. John, thanks very much for coming to the Gold Summit, for being part of this. I know you have a presentation following this as well, so I'm looking forward to that. I haven't seen your notes on it yet, so I hope all the viewers who have enjoyed this video will join us for that as well.